Most people couldn't name the Fed chair if you put a gun to their head. And that's exactly how the system wants it. Because the Fed chair is, without exaggeration, the most powerful, unelected person in the entire global economy. More powerful than most presidents. More powerful than most CEOs. When the Fed chair speaks, trillions of dollars move within seconds. Jerome Powell's term ended, and the transition of power at the Federal Reserve is something that doesn't get nearly enough attention in mainstream financial media. What gets even less attention is the philosophical shift that comes with a new chair. Because every Fed chair brings a different set of priorities, a different economic worldview, and a different tolerance for what we're going to call creative monetary policy. And right now, the signals coming out of the Federal Reserve are pointing towards something that financial historians will recognize immediately. Something that happened after World War II. Something that happened in Japan. Something that is right now being quietly engineered in the background while everybody is distracted arguing about tariffs and tech stocks. That something is called yield curve control, combined with a policy environment designed to produce negative real interest rates over a sustained period of time. Don't let those terms scare you. By the time I'm done explaining this, it's going to be crystal clear, and it's going to change the way you think about your debt forever. The mechanism. What is silent erasure? Let me give you the simplest possible version of this first, and then we'll go deeper. Inflation erases debt. That's the core concept. When the purchasing power of money goes down, the real value of fixed debts goes down with it. If you owe $300,000 on your mortgage and inflation runs at 6% per year for 5 years, the real value of that debt has been cut dramatically, even if the nominal number on your statement hasn't changed one single dollar. Now here's where it gets interesting. The Fed has a tool, multiple tools actually, to engineer a situation where inflation runs persistently above the interest rates being paid on debt. When that happens, the real cost of holding debt becomes negative. You are effectively being paid to be in debt. The bank lent you money and inflation is quietly handing you a discount every single month. This is not an accident. This is a policy choice, and it has a name in academic economics: financial repression. Financial repression is when governments and central banks deliberately keep interest rates below the rate of inflation, forcing savers to subsidize debtors. It transfers wealth, silently, invisibly, without a single vote being cast, from people who saved money to people who borrowed money. And here is the part that nobody in the mainstream financial media wants to say out loud: homeowners with fixed-rate mortgages are the single biggest beneficiaries of financial repression. Let that sink in for a second, because it completely flips the narrative you've been sold your entire life. You've been told that debt is bad, debt is dangerous, debt is the enemy. And in some contexts, that's absolutely true. But in a financial repression environment, in an environment where the Fed is deliberately keeping real rates negative, fixed-rate debt is not a burden. It's a weapon. And right now you might already be holding it without even realizing it. The historical proof. This has happened before. I need you to understand that this isn't speculation. This isn't some fringe economic theory cooked up on a Reddit forum. This is documented history with receipts. After World War II, the United States was carrying an absolutely catastrophic debt load. The national debt was over 100% of GDP. By any conventional measure, the U.S. should have gone through decades of painful austerity, brutal spending cuts, crushing tax hikes. That's what most economists at the time expected. That's not what happened. What happened was a 25-year period of deliberate financial repression. The Fed, in coordination with the Treasury, held interest rates artificially low while the economy grew and inflation ticked steadily upward. Savers got crushed. People with fixed-rate mortgages on their homes, they watched their real debt burden evaporate. The $15,000 mortgage that felt enormous in 1946 felt like almost nothing by 1965. Not because they paid it down aggressively, not because they got a raise, but because money itself became worth less, year after year after year. The national debt was inflated away. Private debts were inflated away. And an entire generation of homeowners accidentally became wealthy, not through genius investing, not through aggressive saving, but simply because they were on the right side of a monetary policy decision they never even understood. Japan implemented a formal version of this too, through what became an official yield curve control policy. The European Central Bank has maintained negative real rates for extended periods. And now all the structural indicators are pointing toward the United States doing it again, more deliberately, more aggressively, and with modern tools that make it even more powerful than anything we saw in the post-war era. History doesn't repeat exactly, but it rhymes with remarkable precision when the same fiscal pressures emerge. The new chair's signals, reading between the lines. Here's where I want you to pay very close attention, because this is where most financial commentary completely falls apart. Everyone focuses on what the Fed says publicly, the press conferences, the congressional testimonies, the carefully worded official statements. What matters infinitely more is what the Fed does structurally. And structurally, there are three enormous signals that most people are completely missing. Signal 1. The Average Inflation Targeting Framework. A few years ago, the Fed quietly shifted its inflation framework to something called Average Inflation Targeting, or AIT. Under the old framework, the moment inflation consistently hit 2%, the Fed was supposed to start tightening aggressively. Under AIT, the Fed is allowed, and this is written directly into their own official policy documents, to let inflation run above 2% for an extended period in order to make up for previous periods of below-target inflation. This is not a minor technical adjustment buried in footnotes. This is an institutional green light for sustained above-target inflation baked into the Fed's operating mandate. The new chair inherited this framework and has shown zero interest in abandoning it. In fact, every signal points toward doubling down on it. Signal 2. Treasury market pressures and yield curve dynamics. The U.S. government is constantly rolling over trillions of dollars of existing debt. If long-term interest rates spike significantly, that debt rollover becomes fiscally catastrophic for the federal budget. We're talking about interest payments that could consume a massive share of all tax revenue. The Fed understands this math. The new chair understands this math. There's enormous institutional pressure, not conspiracy, just basic fiscal arithmetic, to keep long-term rates suppressed relative to where inflation is actually running. Yield curve control is the formal implementation of this logic. The Bank of Japan announced it explicitly. They would cap 10-year government bond yields at a specific target and purchase unlimited bonds to enforce that cap, no matter what. The Fed has not made a formal public announcement of this policy, but multiple Federal Reserve regional presidents have discussed the concept openly in interviews and academic papers. And the balance sheet expansion mechanisms the Fed developed and deployed during COVID represent a near-identical toolkit. The infrastructure for yield curve control in the United States already exists. It just hasn't been officially activated yet. Signal 3. The political economy of housing. Here's an angle that almost never gets discussed in mainstream financial media. Politically, housing affordability is one of the most explosive issues in America right now. Home ownership rates among younger demographics have collapsed. An entire generation feels permanently locked out of the housing market. Any politician or institution seen as actively helping existing homeowners at the expense of would-be buyers faces enormous backlash. But financial repression helps existing mortgaged homeowners without the Fed ever having to announce it. There is no press conference where they say, "We are deliberately eroding the real value of your mortgage to benefit people who already own homes." It just happens, silently, mathematically, through the gap between nominal debt obligations and the real purchasing power of the dollars used to pay them. The new Fed chair does not operate in a political vacuum. The institutional incentives, the fiscal pressures, the policy frameworks, and the political dynamics all point in the same direction. And that direction has very specific implications for anyone carrying a fixed-rate mortgage. Who gets hurt? The other side of this trade. I want to be completely honest with you here because this is not a story where everyone wins. Financial repression is a zero-sum wealth transfer mechanism, and the people on the losing end of it deserve to understand what's happening to them. Every dollar that a mortgaged homeowner saves in real debt burden has to come from somewhere, and it comes from savers. If you have significant cash sitting in a regular savings account, a money market fund, or low-yielding bonds, and inflation is running at 5% while your account is paying 2%, you are losing 3% of your real purchasing power every single year. Not through a stock market crash, not through a bad investment decision, through the slow, invisible, relentless math of inflation running above your yield, silently, without anyone ever standing up and admitting it's happening. This is precisely why genuinely wealthy people almost never hold large portions of their net worth in cash. They own real assets, real estate, operating businesses, commodities, equities with pricing power, because they understand, either intuitively or explicitly, that the monetary system is structurally and consistently biased against cash savers and in favor of real asset owners with fixed nominal liabilities. Retirees on fixed incomes get hurt particularly hard by this dynamic. People in long-duration government bonds get crushed. People whose retirement income comes from fixed nominal annuity payments watch their purchasing power decline year after year in ways they never modeled when they signed up. If your entire financial plan is built around receiving fixed nominal income streams, financial repression is the single biggest threat to your retirement, and it's one that almost no mainstream financial advisor ever addresses directly. What this means for your mortgage. Specifically, let's get completely concrete. Real numbers, real math, no more abstractions. You have a $400,000 mortgage at a fixed rate of 6.5%. Your monthly payment is locked. It is a fixed nominal obligation. It does not adjust upward when inflation rises. The bank cannot come back and change your rate because they miscalculated what monetary policy was going to do. You're locked in. Now imagine the Fed engineers, through average inflation targeting, through yield curve control mechanics, through ongoing balance sheet operations, a period where inflation runs at an average of 5.5% annually for the next 7 to 10 years. This is not an extreme scenario. This is within the range of what the post-Boba II episode actually produced. In nominal terms, your mortgage balance is declining gradually as you make your regular monthly payments. But in real terms, in actual purchasing power, that $400,000 balance is being quietly and systematically dismantled by inflation. The dollars you will use to make your future mortgage payments are going to be worth less than the dollars you borrowed, significantly less. That difference is pure silent wealth transfer, from the bank's balance sheet to yours. Meanwhile, your property, a tangible, real, hard asset, is in all likelihood appreciating in nominal terms at or above the inflation rate. Because real assets, by definition, tend to preserve and often amplify their value in inflationary environments. Your asset appreciates in real terms. Your liability shrinks in real terms. That is the trade. That is the complete mechanism. and it requires you to do absolutely nothing except hold your fixed-rate mortgage and not panic when inflation headlines spike. Now, and this is critical, does this mean you should go out tomorrow and take on as much debt as humanly possible? Absolutely not. The mechanism works specifically and exclusively for fixed-rate debt. Variable rate debt is not just a different story. It's the opposite story. If inflation runs hot and the Fed loses control of the front end of the yield curve before repression fully locks in, variable rate borrowers can get absolutely obliterated by rising payments. Fixed rate. You are a potential beneficiary of financial repression. Variable rate. You are a potential victim of it. This is the single most important distinction in this entire video. Write it down. The real estate angle. Why property becomes the ultimate hedge. In every single documented historical episode of sustained financial repression, post-W2 in America, modern Japan, post-financial crisis Europe, real estate has dramatically outperformed cash and fixed income assets. And there's a very clean, logical reason for why this keeps happening. Real estate is a leveraged position in a real asset, financed with fixed nominal debt. When you purchase a home with a mortgage, you are structurally making a leveraged bet that hard assets will preserve their value against monetary debasement. You put 20% down and you control 100% of the asset's upside. The bank financed the remaining 80%. At a fixed rate in nominal dollars, with no mechanism to adjust your payment if their real return gets eroded by inflation. When inflation runs persistently above the mortgage rate, the dynamics become extraordinary. The real value of your liability shrinks every year. The real value of your asset holds or increases. The leverage you employed at purchase amplifies both effects simultaneously. This is not sophisticated hedge fund strategy. This is basic math, available to any household with a fixed-rate mortgage. This is precisely why institutional capital has been flooding into residential real estate for the past decade. Blackstone, Invitation Homes, every major sovereign wealth fund with U.S. real estate exposure. They are not doing this out of affection for suburban neighborhoods. They understand the monetary policy environment. They understand the financial repression playbook, and they are positioning accordingly at massive scale. The individual homeowner sitting on a 30-year fixed-rate mortgage has access to the exact same structural trade. The difference is that most individual homeowners have no idea they're holding one of the most powerful financial instruments available in a repression environment, because nobody ever explained it to them in plain language. What you should do right now. Here is a concrete action plan, not vague platitudes, not generic advice, specific steps in order of priority. First, audit every debt you carry. Write them all down. Separate them ruthlessly into two categories, fixed rate and variable rate. Understand the rate, the remaining term, and whether it's truly fixed or has any adjustable component hidden in the fine print. Second, lock in fixed rates wherever you still can. If you are carrying variable rate debt, a HELOC, an adjustable rate mortgage, variable rate business debt, and there is any pathway to converting it to a fixed rate, explore it immediately. Yes, even at rates that feel high relative to what you remember from 2021. If the financial repression thesis plays out, a rate that feels painful today becomes cheap in real terms faster than you'd expect. Third, ruthlessly minimize idle cash beyond your emergency fund. Your emergency fund is sacred. Keep it fully funded, liquid, accessible. But cash beyond that, sitting in low-yield accounts while inflation runs above it, is not a conservative position. It is an active, ongoing wealth destruction decision. It just doesn't feel that way because the losses are invisible and gradual rather than sudden and obvious. Fourth, increase your exposure to real assets. Real estate is the most accessible and historically proven vehicle. But it's not the only one. Commodity-producing equities, inflation-protected treasury securities, real asset infrastructure funds, international real estate exposure, all of these can serve as hedges against the specific risk that financial repression poses to fixed nominal wealth. Fifth, think in real terms, not nominal terms. This is a mental habit more than a specific action, but it might be the most important thing on this list. Train yourself to always ask, what is this asset worth in purchasing power, not just in dollar terms? What is this debt costing me in real terms, not just in nominal interest? The people who navigate financial repression successfully are the ones who make this mental shift early. The bigger picture, what this says about the system. The fact that we live in a world where the most consequential financial decisions affecting hundreds of millions of households are made by a small committee of unelected economists, and where the implications of those decisions are communicated in dense academic language, specifically engineered to be inaccessible to ordinary people. That is not a flaw in the system. That is the system working as designed. The gap between people who understand how monetary policy actually works and people who don't is one of the largest and most durable sources of wealth inequality in modern economies. It has nothing to do with intelligence. It has nothing to do with work ethic. It has everything to do with access to information that someone bothered to translate into plain language. Financial literacy does not let you beat the system. Nothing lets you beat the system, but it lets you understand which direction the current is flowing, so you can position yourself to move with it rather than exhaust yourself fighting against it. The new Fed chair's policy environment, whether explicit or implicit, formally announced or quietly engineered, is pointing toward a sustained period where debtors are systematically rewarded and cash savers are systematically penalized. The historical playbook is clear. The structural signals are consistent. And now you know what you're looking at when you see it. What you do with that knowledge is entirely up to you.